Hello, and welcome to today's Family Investment Companies webinar. Apologies for the feedback there. We have some slight technical issues. Uh, the plan for today is to run through the various different aspects of family investment company and when we might use one of those. And there are a number of slides that we've got to get through, so we probably will take the full hour just going through the content. But I am very happy to stay at the end and just cover off any questions that anyone might have. And if you don't want to put those questions in the chat function, or if you prefer to email afterwards, then my email address will be on the last slide. I'm very happy to answer those questions after the presentation. So without further ado, we'll make a start. Okay, so let's start nice and simple. What is a family investment company, or what is a FIC? So these are not particularly fancy types of company. These are just normal companies, but they've got family shareholders. So that may not be anything particularly different to any normal limited company. We might have companies that have family shareholders and other non-family members as shareholders as well. And so there's nothing so far that's particularly special about this particular structure. And for us in particular, we may start out with what is a family trading company. We're an accountancy firm and we deal with different trading businesses day to day. They might have this structure, but not be an investment business. And I'll add yet to that, as we will see as we go through the slides. So, what makes a family investment company different to normal companies? Well, generally speaking, that's because they've got alphabet shares. And that's not, again, specific just to family investment companies. It's also something that other trading companies have that don't have family members. And the reason we have this is because the alphabet shares give you the rights, or the ability to put different rights on different classes of shares. So that might be useful if you've got people joining your company that you don't want to give away your current value. You can then put capital restriction rights on their shares, or you can put voting restriction rights on shares as well. And there's also flexibility of dividends, and that's where we will be focusing more today on the different tax implications of that flexibility and what we can do with those alphabet shares. Apologies, it is working, it is just lagging slightly. So, benefit number one is the flexibility of dividend payments. If we have different classes of shares between different family members, we can then pay all of the dividends on the A shares and nothing on the B, or we can spread it equally if we want. We have that control over what we can pay each year and what we don't want to pay. That can create income tax savings when we're looking at a family situation, which can be really helpful. It can also create inheritance tax savings. And we can also use the rights on the shares to create some protection, some control over the family unit, and to make sure that we keep control usually with the main shareholder. So let's start with looking at the income tax savings and why we might use a family investment company. So we can take a very basic structure. We just got a company, GH Limited, and that company has 100 ordinary shares in issue. Now, if those shares are split 50 shares each to Mr. and Mrs., then what happens is the dividend is paid equally to each of them because you have to pay your dividend pro rata according to your percentage shareholding in the company. Now, you can see little piggy banks on this picture. George in this scenario is a basic rate taxpayer. So that means he would pay 10.75% tax on his dividend that he's received. But Gemma in this scenario is a higher rate taxpayer. So she would pay at 35.75%. So there's a discrepancy there. And the way we can fix this is with alphabet shares. So we could transfer George's shares to 50A shares and Gemma's shares to 50B shares. And what that means then is in the year, we might declare the dividends all on George's A shares and nothing on Gemma's B's. And that enables all of that dividend to then be taxed at 10.75%. So the company's paid exactly the same dividend, but the amount the couple have received in their hands is higher because of that flexibility we get from those alphabet shares. And if we use this example with a more extreme version, so a basic rate taxpayer to an additional rate taxpayer, we can save 28.6% of income tax each year on that dividend. And then if you're in that horrible place where your income's over 100,000 and your personal allowance is tapered, we can actually save 48.28%, so a little bit higher again. So very basic scenario, but some really big savings year on year. We can also use this to avoid the high income child benefit charge. This is never calculated very well. So if one of the couple earns over 60,000, then you can get the high income child benefit charge. But if both of the couple earned 59,000, you wouldn't have that. And so this flexibility allows us to make sure we're using whatever reliefs and allowances we can get to push income or spread income between the family members and save these different tax implications. Another thing we can use alphabet shares for is children. So they can be useful to pay school or university fees. And again, it will be a similar structure. So we're looking at maybe in this scenario, 50A shares for mum and 50B shares for the daughter. And again, we have that flexibility to pay those dividends on the B shares to enable the daughter to benefit from the lower tax rates on that income. And that's particularly helpful if the mum would fund her anyway for her university fees, for example. So if we take this in a numerical example, because remember, background is an accountant, so we always like to look at the numbers. If the daughter could be paid £13,070 a year while she's at university and got no other income, then that would be tax-free on her within her personal allowance and her dividend allowance. And that otherwise would have been taxed at 39.35% on mum. So what we've saved here is £5,143, and that's a year. So we're looking at about 50.5 grand over a standard 3-year degree. So that's great. It's a really good saving. There will be some admin costs because you would have to complete a tax return for the daughter, even though there is no tax payable. Unfortunately, if your dividend goes over 10,000, that's a tax return reporting requirement. But the tax return's not going to cost you 50.5 grand over the 3 years. So you're still going to be quids in with this scenario. With everything with HMRC that is good, there is always anti-avoidance. So I always like to consider this as like an obstacle course. If you want to get to the end and you want to win, you've just got to go through the different hurdles to get there. And you can't shortcut to the end because if you do, you will not win the race. You will end up getting penalised or disqualified. And that's a very similar scenario to what we would have here with family investment companies. And I'll refer back to that example as we go through. But if we look at it purely from an income perspective, the anti-avoidance in this area is all to do with what they call the settlements legislation. So when you're looking at here, is there a settlement? Because ultimately, HMRC, they don't like this. This will save you a lot of tax. And accountants, obviously, we do like this because we want to save you a lot of tax. But as long as we're compliant with the rules, then we're fine. So there are two types of settlements we need to think about here. The first is arisen from a case called Arctic Systems. And this is where you're giving someone substantially a right to income. So if we look at what rights we can have on shares, we can have income rights, capital rights, and voting rights. And you might have shares which have got all three, or you might have shares that actually don't give you rights to all three. So perhaps we might take out the voting rights on the shares. As long as we've still got two, we've still got the income and the capital, that would be fine. That wouldn't create a settlement. And so when we're looking at the situation for the husband and wife shares, you need to have at least two of the three rights to ensure you're not falling foul of the settlements legislation. If we do fall foul of that, the dividend's taxed back on the husband, and therefore we're back in this scenario we were before. We haven't saved any tax at all. The other scenario we have for settlements is when you have a gift from a parent to a minor child. So that's a child under the age of 18, and that gift creates income of £100 or more per year. If it does, the income is taxable on the parent, and it's not taxable just the excess over 100. All of the income is taxable on the parent. So again, it's undoing the planning that you'd otherwise do. But of course, with any sort of rule, we just look at what the exact wording is, and is there ways we can work around this wording to actually achieve what we want to? So looking at that point, we've got gift from a parent to an under 18 child and income over £100 a year. So if we look at this logically and think, what could we do around this? Well, what about if we didn't make the gift from a parent? What if that gift was from a grandparent instead to an under 18 with income over 100? Well, that wouldn't be within the settlements legislation, so that would be fine. Or the parent could gift shares to the child, but then not pay any income on those shares while they're under 18. And again, that would be fine because it wouldn't be within the settlements legislation because when they receive that income, they are over 18. Alternatively, we look at ways we can do this without making any gift at all. So can the parent sorry, can the child subscribe for shares in their own right? Can they use maybe funds that they've been given from the grandparents to make that subscription? And so these were the options available to us. So yes, HMRC don't like it particularly, and they have put measures in place to try and prevent the abuse of these types of structures. But as long as we work within those rules, then we should be fine. I will caveat that with one recent change that HMRC have made. This is a new rule in relation to the tax return disclosure. And this is for close companies, which is, to be honest, most of our family companies, anyone with 5 or fewer participators. And in this scenario, you have to disclose what your highest percentage shareholding in the company is and your dividend income. And it's not because HMRC are not going to let you have that or going to change that, but they are just gathering information at this stage. They're trying to establish really what the tax leakage is here, and if they need to take further measures to try and prevent this. Now, this has created quite a concern for accountants because all of that flexibility that we've just looked at and that ability to pay different rates of dividend on those different classes of shares would be undone if they made the change we fear the most, which is where they say you can't have that dividend discretionary ability. You have to pay the same rate of dividend proportionate to the percentage shareholding. And that I think would probably be the biggest fear of accountants. And this is the one that I do see a lot of people raising, or accountants having concerns with. And I suppose this is the precursor to, is that that's what's coming in next? But I would really confirm that actually that's not in place now. So yes, it might be a concern that we have, but unless or until those rules are actually brought in, we can still operate within the family investment company structures that we use at the moment. So let's look now at inheritance tax and what tax savings we can make here. And we're going to look here at the previous example that we had, where we had 50 shares for the parent and 50 shares for the child. And that obviously gave us the flexibility to pay income, we hope, and will continue for the future. But it also gives us protection on the family shares because we've taken the voting rights off the daughter's shares, perhaps, and we can look again at that further in the slides. But what we could do, if we're looking at inheritance tax in particular, is we can change those shares. So actually, maybe dad's only got 2 shares and the daughter's got the other 98. And the reason we would do this is because the value in dad's estate for inheritance tax is then only 2% of the company value. So he's managed to transfer 98% of the company to his daughter. If his daughter doesn't have any voting rights, then his 2% of the shares is actually 100% of the control of that company. And because they're alphabet shares, A and B, as long as we put discretionary rights on those, he could still carry on receiving the same dividend with 2 shares as he was with 50. So really brilliant options for us when we're looking at inheritance tax planning. And let's look at that in terms of numbers. If the company is worth 2 million and we've only got 2% shareholding for the parents, then actually we're looking at £80,000 between them, as that's the value in their estate. And we've moved 1.96 million of value across to the daughter, avoiding inheritance tax on that value, which is excellent. And that's a £784,000 inheritance tax saving, which I'm pretty sure everyone would be happy with. And then there's another instance when alphabet shares can be really useful. And this is one of the things that people raise with me the most is, what about if I go into care? And it is a real concern because we see people go one of 2 ways usually. Either they don't go out so much and therefore their pot of funds increases, the value of their estate increases, and therefore their inheritance tax exposure increases as well. Or it goes the other way, they do go into care and then, yes, their IHT liability is lower, but that's because their estate is hemorrhaging money to pay for that care. So people worry when they're looking at what can I give away is, but what if I need it in the future? How do I get it back? And the IHT legislation is very restrictive. So for most things, almost everything, if you give something away, you have to give it away entirely. You can't put any conditions on it that you want it back in the future. And that can be a big hindrance for people in terms of trying to do some planning for IHT and trying to help their children in the long run. But the family investment company really comes into its own here. Because of that flexibility with the dividends and the alphabet shares, you can give the value away. You can give those shares away in the capital value, but there is that flexibility in the future. If you did turn around and say, well, actually, we need more money because the parent has gone into care, you can pay those higher dividends on those parents' shares, even if they're only 2% of the company. And that really helps give people comfort in the long run. I'm saying this, of course, with the caveat of this is the recent change that we've had in the legislation, and this is the recent disclosure we need to put on the tax returns. If this did come in, that would obviously undo that planning. So it's something we've got to be mindful of. And I would remind you again, this is not in force at the moment that you have to pay pro rata dividends, but it is something that is concerning a number of people, I would say. So just bear that in mind before you make any definite decisions with your family investment company. So moving on to the final section on terms of the basics of the family investment company is control and protection. So we've already talked about how we can retain control through the share rights. So that's making sure we take the voting rights off the shares for children. But there are other ways that we can also maintain control if that's what you'd like to do. So you can hold the controlling shareholding in your company and then only give the excess to children. So when we look at control, we quite often look at the 51% because that gives you the majority shares. But actually, there is a second control holding of 75%, which is relevant if you want to pass a special resolution. And that might be the case if you want to sell the company. So, for example, if you think, actually, I'll just do some planning, let's give some shares to my kids. And then we're doing this now with a view to selling the company and getting the proceeds in and doing some brilliant inheritance tax planning. But actually, when you get there, you own less than 75% of the shares, and your children turn around and say, actually, Dad, we don't want to sell. Well, that's a problem for you then, because you don't have the ability to force that through unless you have 75% of the control of the company. So it's just different factors that you need to consider when you're thinking about what you give away. So ultimately, the shareholding in the FIC is one of the most fundamental things that you will need to agree at the start because it's difficult to change as you go through. The other aspects we need to consider are protection, and we can do this in various ways with the company. So one way is a shareholders agreement. And we might put in this, if you're a bad leaver, then you have to sell the shares back to the company at nominal value. We do that more often for employees, to be honest, but that can equally work for children. If they're misbehaving, they become a bad leaver. So we can have some protection in that way. We can also put some protection in the articles of the company. And quite often we put things like bloodline articles. So you can't pass the shares to anyone who isn't a blood relative. And that stops your children's passing to their spouses, passing to partners or friends or anything like that. So the shares can't leave the family unit. What we can't do, however, is protect in the event of divorce. And that's because even if we put all these restrictions in, if we have given 98% of the company to your daughter and your daughter then gets divorced, the departing spouse might not be able to take the shares because of the shareholders agreements and the article restrictions we put in, but the value of those 98% of the shares would be included in her Form E in the divorce form in recognising the assets of the estate. And the problem with that is that if she keeps the shares, what is she losing then? Because she might be losing the house, for example. And so in this scenario, we can still use a family investment company. It can still be relevant, but we might put in a trust as a shareholder instead. And that's because if we have a discretionary trust in place, what your daughter holds is nothing effectively. It's a hope that the trustees would exercise their discretion in her favour. So when we look at that from a divorce perspective, if she owns nothing, there's nothing that we can put on the value for the Form E. If she predeceased unexpectedly early, then there isn't a value to also include in her estate at death. So that can give more protection than just a pure shareholding in a company. And sometimes we put these in alongside direct shares for individuals. And sometimes we put them in as the only shares for children. And they can be particularly helpful as well if someone has a child with addiction issues. So drug addiction, gambling addiction, things like that. So there is a place for them alongside family investment companies, but they are complex. I can't go into trust really anymore today because we're in limited time. This would be a session in itself, but it's something that you might just want to consider if you've got your personal situation requires a little bit more protection than just outright ownership for your children. So now that we've covered the fundamentals of a FIC and what you need to think about and all the benefits of them, let's look at how we create a FIC. So essentially there are two ways. You can either use an existing company or you can create a new company. And we're going to look at how and when we might use those different scenarios. If we use an existing company, this is one of the things that I would do the most because we work with a lot of trading businesses. So we would start with a family trading company. And this company might not have lots of different shareholders. It might start with just one shareholder. He owns all of the shares, all 100. And we might start with looking at, can we gift shares to family members? Can we recategorize them so we've got those rights that we've talked about? And we will have to think about things like, have we triggered a capital gains tax charge? Can we claim holdover relief so we don't have that capital gains tax charge? So we'll need to consider what the business is, whether we qualify for those reliefs, so we don't inadvertently trigger tax charges we didn't want. What we then do when we've got our structure in place is we might want to sell the business in the future. And if we sold the trade and assets of the business, there would be gains within the company, but the proceeds would also be in the company in the existing inheritance tax structure that we wanted. So then we can just strip feed things out between family members, taking advantage of those income tax savings, taking advantage of those inheritance tax savings. So this can work really well if you've got an existing family traded company. It can also work well if actually you want to sell a subsidiary and you don't need the proceeds. And this is probably the big point. If you don't need the proceeds can go into your family company, which is now a family investment company, and then can be drip fed out. If you need those proceeds because perhaps you want to buy a new house or you want to build an extension on your existing house, then you might need to wind up your company after you've made that sale and then take out the proceeds to pay for whatever it is that you need at that time. And there are different routes to what we would look at for each scenario. But ultimately, if you went down this route of selling the trading assets, proceeds in the company, or selling the trading subsidiary proceeds in the company, then you have the option going forward of extracting profits as either salary or as dividend. And I just wanted to just give a bit more of an example of what I mean when I talk about the trading subsidiary. So if you had a business with your company premises in, when I do a lot of company sales, sometimes you're restricting your buyers if you keep the premises as part of the sale. So what you could do instead is you could create a new holding company. And that buys all the shares of the existing trading company in exchange for your shares. So you're still the shareholder of the group now rather than the company. And you move your trading premises up. So the trading premises is now in the holding company rather than the trading subsidiary. And if you then sold this trading subsidiary after a year, uh, and it was trading business, you met all the other conditions for substantial shareholding exemption, what can happen is the gain in your holding company is free of corporation tax. So you've got your proceeds in there, you paid no tax on it. You've got your premises in there, which you rent to your new the new buyer of your company. Or if that doesn't work, you can sell the whole group. So you sell the holding company and the trading company, and then you're just left with that pot of proceeds. And if you are left with the pot of proceeds, then we're going down the create a new company route. And that's where you set up a new company with exactly the shareholders that you want in the rights classes that you want right at the start. And then you loan those proceeds of sale of your business to this new company. And at that point, of course, the company won't have any value. So it'll have cash from you, yes, but it'll also owe that same cash back to you. So the net value is nil. So you haven't made a gift at that point, and that's a really, really important point. But also with a new company, I really like these better, if I'm honest, because we have so many more options at how we extract value. So we can do the salary and dividend, as we looked at previously with existing companies that might have previously been family trading companies. But also now we have loans, so we can charge interest on the loan. And you can actually get around £17,000 of funds out of the company as interest using savings allowances and starting rate bands, in addition to your personal allowances and your dividend allowances. But we've got opening up different avenues in terms of reliefs and allowances we can take advantage of. Also, if you need any more, you can then take a loan repayment, which will be tax free. So we have a lot more flexibility with a brand new company than we had with an existing. But of course, we have already paid capital gains tax to get that money out from the existing company if we want to set it up as a new one. Whereas if you can use an existing company and you can claim substantial shareholding exemption, there's the ability to not pay capital gains tax at all. And obviously, no tax is better than some tax. So what do we want to hold in our family investment company? Well, the loans, we've talked about that already. But actually, there are some things which are quite advantageous to hold in a family investment company or in a corporate wrapper generally. So, one of those is rental properties. And that's because you can get a full interest deduction on your mortgage interest in a company, which you wouldn't be able to get if you held that property personally. So, if that's your thing, you like investing in property, then putting that property into a company would be better than holding it personally. Although it's not a one size fits all, because you've got to think about how much you're extracting from the company and whether that double taxation has eroded any benefit. You also have shares, which can be received in a company tax free. So we're talking UK company to UK company dividends, and that can be really helpful. So if you've sold your business and you want to retire and have a more easier lifestyle in your future, you can give a pot of money to a financial advisor who will invest in shares for you. They're tax free within your company, so no tax at all on those profits, which is not the case if you held the share portfolio personally. Obviously, you can use ISAs, but they're restricted amounts that you can put into those. So tax-free compared to tax on you up to 40%, it's really a no-brainer in that perspective. I say 40%, sorry, 47% now with the new rates. So one area I just want to touch on, because this is a set of webinars that we're doing this year, and this one links back to what we did earlier when we looked at properties and whether you can incorporate a property portfolio. So in an ideal world, I would always like a nice a pot of money which you use to buy property, and it's nice and clean. But actually, we do come across a lot of people that have an existing property portfolio, and now ideally they want to put it into a company, and they want to put it into a company for exactly the reasons we've covered. So they want the full mortgage interest deduction. They want the ability to roll up profits if they don't need to draw them, and then they're only being taxed on what they actually need. They can also use their family's basic rate bands, personal allowances, so all of these good things. But if you already have an existing property portfolio, you do have some difficulties there, because the only way you can move that into the company is usually paying stamp duty, land tax, and capital gains tax. So the company would have to pay the stamp duty, land tax to acquire the properties, and you would have a deemed capital gain when you transfer the properties in. So there are some reliefs, as we talked about in the previous webinar, which can remove your stamp duty land tax charge, and or the capital gains tax charge. But actually, in most cases, you wouldn't want to claim those reliefs. And that's because if we take an example of £1 million portfolio, that's £1 million that you could draw if you sold those properties to the company. You could draw that £1 million out tax free as your payment of your proceeds. And that's saving you tax would otherwise be at 45%, 47% on rental profits, because they're now in the company and being extracted out. So that's a good thing. And your cost of doing that is maybe you've got a £200,000 gain and you're paying 24% capital gains tax on that 200,000 gain. So that's your difference. A million at 47% income tax, or 200,000 at 24% capital gains tax. There's a real benefit there for you in the longer term. But therein lies the problem, because you will have to pay the capital gains in the short term. You might not have the funds from the first year of rental profits to be able to cover that and pay that out to you to pay the tax. The company will also have to pay the stamp duty, land tax upfront. So for most people, the challenge of the short-term cash flow disadvantage of the stamp duty, land tax and the CGT means they can't go down this route, which would be really advantageous to them in the long run of incorporating their property portfolio. And those that can and do use the stamp duty, land tax and CGT reliefs to establish a property portfolio within a company with the various incorporation reliefs, they can't get the income tax and the inheritance tax advantages we've discussed, because once you've incorporated your property portfolio, you can't then start moving your shares easily between your family members. And that's because it will trigger the gains that you've rolled in. It will also trigger removal of the stamp duty, land tax reliefs. So it's a really, really tricky one, that particular area. And it's not really a fun landscape for landlords generally at the moment. We did mention earlier as well about the double taxation on profits. Sometimes people come in and say to me that it's always better to have a company, and I just want the better tax solution, but it's never one size fits all. So if you need all of the profits every year, then yes, putting them in a company will give you full mortgage interest deduction. But if you haven't got a mortgage, it's not going to give you a benefit. Uh, if you're a single person, so you've got no spouse or children, then you haven't got that ability to benefit from the different family personal allowances and basic rate bands. So in some of those scenarios, actually, your company's worse for you because it's not going to save you any money because of the double taxation of the profits, but it's also going to cost you money because now you have to run a company that you don't really need. So it's always just making sure you've thought through the different aspects before you go ahead with your family investment company. Just to summarize what we've covered in that section, we've talked about the residential properties, which are good to go in a family investment company. That doesn't mean commercial properties are bad. It's just residential properties are particularly advantageous because of those reliefs on the mortgage interest. And that's the same for shares in listed companies or shares in unlisted trading companies. Again, they're not necessarily better than anything else in terms of what you hold in that corporate wrapper and what you invest in. I'm absolutely not an investment advisor, but they are tax-free income if it's shares, whereas if you had a bank account in there which is earning interest, that wouldn't be. So that might just sway you in terms of which is a preferable investment for you. But you should also obviously consider the return on the investment as well as the tax. I wanted to include this particular slide because there are some things which are bad to put in a family investment company. So one of these things is the family home. I'm asked this a lot. Can I just put my family home in there? That would save me loads of inheritance tax. There's a variety of reasons why that won't work. There's the residence nil rate band for inheritance tax now. If you don't have a home because it's in your company, then you will not get that residence nil rate band. So you've lost 175,000 per spouse, and that's 140,000 inheritance tax relief in total that you could otherwise have benefited from. If your home is in the company as well, when it sells in the future and makes a gain, you will not qualify for your main residence relief. And that's because that's only an individual relief. Companies don't get that. So any gain will be subject to corporation tax 25%. The government hate houses in companies, particularly homes. So there is something called the annual tax on envelope dwellings, or we refer to it as ATED. And that applies if you have a residential property worth more than 500,000 within your company. And that sits quite nicely, usually with a family home. If you have that, you will pay an annual tax for having that property just in your company, which is not ideal. And even if you have, you maybe you let it out to family members, you would still need to do various reporting as well on the ATED forms. And lastly, for the benefit of living in your own house, you would have to pay a benefit in kind charge every year on your tax return for that accommodation. And that's effectively paying tax on the rental value of your home. So hopefully I've got the point across there that family homes definitely not things you should be putting in your company. And this does extend to family homes for your children. So they might not be over 500,000, so they might not be subject to ATED, but they are still going to be subject to those other points. So no main residence relief, and they're going to have a benefit in kind charge as well. But for some people, although it's not tax efficient, it can still be beneficial for them to put that family home in the company. And that might be if you're really worried from a protection perspective, you want to buy your child a property to live in, but you really don't trust their spouse, maybe. In that instance, having the property in the company gives you that level of protection because they only own the shares, they don't own the property itself. And maybe they've only got two shares, your child, because they might have some kind of gambling addiction or some other addiction. That way, you're allowing them to live there, but you're not going to lose the value of that property in the future. And this might be an alternative, your family investment company, to a trust, which is another way that you could hold properties for your children. But also, for some people, it's the ability to get the funds out of the company. If you've rolled up your dividends on your shares, your portfolio has done really well, and you now have the cash in there to buy that property. If you extracted that even via your children's shares, you could be paying really high levels of income tax on dividends up to 39.35%. Whereas if you just bought the property in the company, it might be less. So particularly if it's property maybe for a university degree, so it's a short term and then will be sold, it might be the case that actually it is the right thing in that particular instance that you buy that property in the company. But as with everything with hope, it's never a one size fits all. So the best way I can ever really show this is through a case study. And this can show all of the things that we've talked about, which just pulls all of them together. And you can see it then in a numerical format, which I always find very helpful. So we're going down the route here of the parents having the 2A shares and the daughter having the 98B shares, which is the scenario we looked at previously. And in this scenario, the daughter's going to be under 18 years old. So we set up the company, brand new company, with £100 of nominal share capital. And that will take the form of two £1 A shares for the parents, one each, and 98 £1 B shares for the daughter. So what they subscribe to invest in that company is £2 for the parents and £98 for the daughter. And very importantly, she does not subscribe herself. Remember, she's under 18. Those shares are subscribed for by her grandmother, who then gives her those shares as a gift. Okay, so the gift comes from the grandmother. The gift is only £98. So from an inheritance tax perspective, the gift is very low. And if we look at this, the top line of this table really is the balance sheet of the company and the parents and the daughter. And the bottom line is the profit and loss account. So in the company, we've got the £100 nominal value of the shares, and the parents have also loaned in £1 million. The company has used that loan to invest in a share portfolio with a financial advisor. And then every year, that portfolio very helpfully makes exactly £113,070. And that income is free of corporation tax because it's dividend income on shares from a UK company shares. So the company can pay that profit out, £100,000 per annum as repayment of the loan to the parents, and that's tax-free for them. And it could pay £13,070 as a dividend, and again, that's tax-free when it's received by the daughter on her 98B shares. And that's because it's not within the settlements legislation, because the gift was made by the grandparent and not by the parents. So at this point in time, we've made some income tax savings because we're able to pay out £13,070 a year to the daughter, which would otherwise be taxed on the parents. And she might use that to pay for private school fees. So that's brilliant. At this point, we haven't made any inheritance tax savings because the parents had £1 million loan before, £1 million of cash before, and now they have £1 million loan due back to them from the company. So they haven't actually decreased their estate at all. What happens as we go through? The last point on that one is that, say over a period of 10 years that it takes to repay that loan, then what we've done is we've obtained £1,130,700 from the company, completely tax-free, and paid out to the daughter and the parents as repayment of loan and as dividends. So that's in the years up to the point that the daughter turns 18. And at that point, the loan is completely clear. So the position changes. So let's look at where we are now. So the parents have retired and the daughter's gone to university. So at this point, they want to take £50,000 of dividends each. They don't have any loan repayment left because they've used all of it. But they can use their personal allowance and dividend allowance to get £13,070 out tax-free each. And then the balance of that, they can take the balance of 50,000, they could take as dividends within their basic rate band. So the maximum rate of tax they're paying on this income receipt is 10.75%. The daughter's gone to university, so she's now over 18. She's receiving £13,070 as a tax-free personal allowance and dividend allowance, and that's helping her fund her university fees. So we've covered the school fees, we're now covering the university fees as well, and we've covered the parents in their retirement because they no longer have employment income. And we put some protection in because there are no voting rights on those B shares. So those 2 A shares owned by the parents have 100% control of the company. Stage 3. Remember, we've cleared the loan. So the company still has the £100 nominal value. There's no loan in place. So if that loan has now just a share portfolio, the company value is £1 million. The parents only own 2% of that £1 million, which is £20,000, and that means the exposure in their estate on their IHT liability is £8,000, and that's assuming all of their other nil rate bands and residence nil rate bands have been utilised against everything else. The daughter has 98B shares, which are now worth £980,000, and this is our main issue with this particular case study. That's her divorce risk. So we put her through school, we put her through university. She is now brilliantly educated. and very attractive to potential suitors. Do we have a potential problem? There may be something we want to do there. Maybe we could have put in trusts to make that a little bit better, but that's our key risk when we look at this scenario. But when we look at it from a income perspective, at this point, maybe the share portfolio is making a 10% return, so 100,000 a year. And again, it's still tax-free because it's dividends from UK shares to a UK company, so there's no corporation tax. And now the parents are really quite elderly at this point. They're receiving state pension, personal pension. They're not really going out so much. So actually, they don't really need that much income. At this point, we could still pay out 13,070 within their personal allowance and dividend allowance. And if they did need that income or they did have that available, or we just don't pay anything at all. We've got that option available because they've got different alphabet shares, the A's and B's. The daughter by now might have a really good job, so she's already using all of her basic rate bands and personal allowances. So maybe just pay £500 a year dividend just to use up her dividend allowance. And then anything we haven't paid out, we can roll up within the company. And that can be rolled up tax-free. Maybe we use it to invest more in the share portfolio. And then we're just creating our ability to create further funds in the future. And one other point that I haven't got on the slide, but which we might want to consider at this point, is if that daughter has now had a child herself, do we want to consider maybe recategorizing those A shares? So maybe they're one A share and one C share. And we give that C share down to the daughter's child, to the grandchild. And then we use those to pay her nursery fees, her private school fees, and things like that. Because again, we're grandparent to grandchild. Or we can maybe multiply up the percentages. So instead of 2 times £1 shares, maybe we make that 20 or 200, and then we multiply again the daughters, and that gives us flexibility to benefit lots of different grandchildren and still hold some shares ourselves. So a family investment company can be with you throughout the growth of your children, can be with you for a long time, and ultimately the plan would be to leave this company to your children or grandchildren when you die. And that's where they really come into their own, because anyone who's ever done any probate on family members or as a professional will know that it's quite difficult trying to get hold of all of the different share providers, to contact land registry and transfer lots of different rental properties. But actually, in terms of the company shares, we just go and update the share register. It's a very simple process, and that transfers all of the family wealth just to the next generation. So you're not just keeping things in one place where you can keep track of it more easily, and using the ability to pay income more flexibly between family members. You're creating inheritance tax savings, but you're also creating estate ease for your children because you can move on the assets easily when you die. There are some further benefits that we might look at in that case study in terms of the loan. So we started with a loan of £1 million, and then we drew down on that as the parents. But actually, sometimes I find that the parents will actually be basic rate taxpayers, and the children are the ones which are higher rate or additional rate taxpayers. And in those scenarios, it might be better to assign the loan to the children right at the start, and that starts your 7-year clock for IHT. So after 7 years, that £1 million loan is outside of your estate. You haven't needed to draw it down, but you're maximising the income tax savings because the people who need to make the higher savings, the people who are paying tax at the higher rates, are your children and not you. And we have got restrictions on that as well. So we could assign the loan, but it can only be drawn down at the discretion of the directors of the family investment company. And in that instance, we'd make that perhaps Mr. and Mrs. or the parents and not the children. And therefore, even though they have given the loan away, if they don't want their children to draw it, they can restrict that in their role as directors and still retain some level of control. So we've talked about how good family investment companies are, how brilliant, how much tax savings they can make. And I think we would all recognise that there is a real place for them, both for families and for employees and things as well. But with everything, we go back to that hurdle, the assault course, the obstacle course. If you want to get to the end and you want to win that race, you have to go through all the obstacles. You have to consider all the obstacles to get there. You can't shortcut. And if you do, you will be penalised, you'll be disqualified. And that is exactly the case here. So great benefits come with great risk and great planning. And I have put just a slide here on what I see most. But this is actually just a list of things that I've seen in the last 6 to 12 months, where people have gone, family investment companies, I understand that, I get it. I want to do one of those, but they haven't put it in quite right. And the cost of putting it in the first place is relatively straightforward and relatively simple, a low cost to get the shares and the structure in place right first time. If you do this wrong and then we have to fix it, it will cost you far, far more. And we can't always fix it perfectly. There might always be some cracks. So if we just run through some of these that I've seen recently, and these sort of don't try these at homes. So first of all was, how did the children get shares? Quite often we see things where we go, oh yeah, my kids have got shares in the company, and we ask, well, how did they get those shares? And people don't know. So there is a difference for tax on whether the shares were issued, were transferred by you, or they were just new shares issued to your children. Both have different tax implications. You have to think about, is there tax reliefs available? Because if not, even though you might have made a gift, you haven't received any proceeds, you could have triggered a capital gains tax liability that you didn't want. Now, we might be able to get around that if we catch it in time by claiming holdover relief, but it's a claim. So you can't just go, well, I gave shares to my kids and they qualify for relief, that's fine. You need to make sure you've actually claimed the reliefs available and they actually qualify for those reliefs in the first place. So understanding of how we're going to get the shares to the children is important. Another one, which is more of a practical implications, is under 18s holding shares. So technically, you could give shares to a brand newborn child, and I do have companies that do exactly that, and that's is very tax efficient because then you've got 1-year-olds, 2-year-olds receiving income, which is tax free within the personal allowance. So you've got lots of years to benefit from those income tax savings. But we would always want to set up our family investment company with a bare trust for those under 18s. And this is because if you don't, you will give yourself issues potentially when you're looking at setting up a bank account, and different aspects where the person who is the shareholder has to sign, because your 1-year-old, your 2-year-old cannot sign those documents. So yes, under 18s can hold shares, absolutely, and it's tax efficient. But have you thought about the practicalities of how they will hold shares? Have you put in place things like a bare trust so parents can act on the child's behalf? Because that's going to make your life easier as you go through. Another one we've seen recently is where someone's gone, we've got alphabet shares, we've got A, B, C, D, and that's fine. That's brilliant. We can pay different levels of dividends because we have those different classes. But actually, there's a specific wording that needs to be in place to have that discretionary dividend ability. If you don't have that wording, then you have to pay pro rata according to the shareholdings. So if you hold 2% of the shares, you can only receive 2% of the dividend distribution, regardless of your shares being A or B. We can correct this, but it's awkward. And if you've done it wrong historically, then under company law, we need to correct it by rectifying those dividends. That can create an income tax charge, which you weren't expecting. Someone's received too much, someone hasn't received enough. And it could be messy. If anything that's messy is costly, I'm sort of doing myself out of professional fees here by trying to point out the things that can go wrong, which I can fix. But it's just so frustrating for us as advisors when we see something that is a relatively straightforward thing to set up, just done slightly wrong, and all of the hassle it can cause if you do that. Another one that I have popped on here is that gifts of shares to employees. Now, that's not quite within the family investment company uh, perspective, but it is something that we do see a lot where people just want to make gifts to their staff, which is a really lovely thing to do, really, really nice. But even though you've received no proceeds, in the same way as gifts of shares to children, there are capital gains tax implications of making those gifts to employees. But even worse for employees, there will be transactions in securities to think about. And there will be employment related securities to think about. And these are all relevant things in a family structure. But in a family structure, you have a sort of opt out because you've got a family relationship override. You don't have that in just an employee relationship. So what you might be giving your employee as is a big income tax liability. So in the short term, they actually receive less salary because you've made a nice gift of shares to them. And they may be less appreciative in that instance than they might otherwise be. That doesn't mean we can't give shares to employees. It just means we need to think about it. And do we maybe need to give them growth shares rather than just outright shares, which give them rights to the full value of the company? And that would bring me on to my very bottom one, actually, is understanding what rights you have given in the shares gifted. So I have come across this in a couple of different instances just in the last couple of months. One was where the the person making the gift of shares thought they'd given a certain class of shares. The person who'd received those shares thought something different, and the lawyer drafting the documents definitely thought something different again. So, what had actually happened was that they'd given rights to the underlying value of the company, which nobody had intended, and it wasn't restricted, which has created all sorts of income tax charges as because it was employees. It's created um, capital gains tax implications as well. And there's a lot of reporting that we need to go back and do retrospectively to try and rectify this. Now, in that scenario, we've been able to fix it. Yes, it's been a bit costly on the way through, but it's been fixable. In the other scenario I had recently where we were trying to sell a company and they thought they'd given their employees shares which just had rights to dividends only. Aside from that being a settlements issue, as we alluded to earlier, what they'd actually given them was full rights to the underlying capital. And then they had to go back to those employees that thought they just had a dividend ability. They thought that was really tax efficient to be able to receive dividends rather than salaries, which just give them some shares. What they'd actually given them is around £100,000 of value in their company. So that had tax implications at the date of the gift. But also, they then had to go back to those employees and say, actually, we didn't mean to do this. We don't really want you to have 100,000. So can you just sign this document that says we did it a bit wrong and you don't want the 100,000? Now, uh, I don't think I would like to have that conversation with my best friend because there's not going to be very many people in the world that would go, no, I don't need 100,000. That's fine. I know mistakes happen. When you're talking big money numbers, people are less likely to go, actually, yeah, that's fine. I know you made a mistake, but I don't need that money. They're going to say, actually, no, I want that money. It's your mistake. I'll have it. Thank you very much. So you see these things when we come to sales scenarios. You don't want to be getting there. You want to have sorted this well before when the employees can't put a value on the shares. But ideally, not make a mistake in the first place. And the final one about the shareholders' agreements, people quite often consider these when they've got employees because they want to make sure that someone's not going to leave them in the lurch or take advantage of them. People forget when it comes to family. They think, oh, we get on really well. We'll always get on really well. And you might do, but incoming spouses for children in particular can create ideas for them that maybe you don't think they would have come up with by themselves. It might change their reflection on how they feel they're being treated in the company. And so we quite often find that families will fall out. And if you have no shareholders agreement in place, it's quite difficult to resolve those arguments easily. So putting those things in place right at the outset will nip any of those arguments in the bud because everyone knows where they stand. So just a few bit of scaremongering, I suppose, just to make sure you do think about this properly and do get it right because it is so much easier to and cheaper to get it right in the first place than it is to rectify it later on. But as I say, the my email address was on the last slide. Um, if you would prefer to email separately, if you don't want to put anything on the chat, I'm very happy for you to send those across, and I will do my best to answer those for you. If there aren't any questions, I will leave the seminar there. Thank you very much for listening, and I hope it was helpful. And I look forward to hopefully working with anyone that I'm not already working with on this soon. Thanks very much. Bye.